Welcome to Made Simple. Today we're going to be talking about how to create a pro forma income statement from scratch. Now, a pro forma income statement is basically an estimated income statement. This is super useful in kind of getting an idea of possible revenues or expenses or possible gross profit for an existing business for the future, or maybe you're starting a new business. Either way, it's really useful in kind of getting an idea of how that business will go, right? All right, so the first thing you need starting a pro forma income statement is you need to know a couple of assumptions. So in this example, we're going to just say that we sell socks, and we have three different types of socks that we sell in our business. So we need to know, so we'll just label these product one, um, product two, and product three, right? So we need to know the dollars collected per unit. We need to know the sales tax collected on each item, the revenue per unit or sales per unit. We also need to know the cost per unit, the gross profit per unit, and the gross margin percentage here. And an additional assumption that we're going to need to know is weekly growth rates, or depending on how we do this income statement, if we're going to do weekly or monthly, we'll just change this to actually monthly. We'll do monthly growth rates. All right. So here for our first product, dollars collected. Let's say that we sell this type of sock for $10, and we're actually going to format this real quick. So let's say we sell that first product for $10, the second for $12, and this one, let's say, $15. All right, so let's just assume a 6% sales tax rate per item. A super simple mistake with sales tax is that you'll just take that 6% and times it by the $10 to get the 60-cent sales tax collected, right? But that would be incorrect. So actually what you need to do is, for revenue per unit, you need to first calculate that. So revenue per unit would be the $10 divided by 1 plus the 6%, and you're going to want to lock this as well. And you go ahead and you get $9.43 of revenue per unit after taxes. So basically what you would do is you take the $10 minus the 943, minus the 943 to get 57 cents instead of 60 cents. Now that is the correct way of calculating the sales tax per unit. Super common mistake again. Just make sure you're not taking the $10 times the 6% to get 60 cents. All right. And then what we can do is just drag these formulas across, since we locked that, and we can get the sales tax collected per product here. All right, so the next thing we need to assume is the cost per unit. All right, and let's just say we're making socks, so let's say it costs $2 to make this sock, $2.50 to make this sock, and another $2.50 to make that sock. All right, so here I'll highlight in yellow the assumptions that you need to know. The rest is kind of math, right? All right, so the gross profit per unit is simply the revenue minus the cost per unit. All right, so per pair of socks that we sell, our gross profit is $7.43. Go ahead, drag that across. All right, so then for our gross margin percentage, we basically just want to take the gross profit divided by the revenue per unit, and we'll drag this across, change this to a percentage, and that's our gross margin percentage. And these are pretty good margins, especially in like a retail business. You're not going to see these type of margins normally. All right, next we're going to want to know a monthly growth rate for each product, and to keep it simple, we're just going to keep it stagnant. It's not going to change month to month. We're just going to do a 1-year forecast, so 12 months, and it's going to have the same growth rate for each month. Let's just say we expect these socks to grow 10%. Product number 2 is going to grow 12% because we're marketing that a little bit more, and 6% for this one, let's say. So now we have our assumptions. Now we need to do a forecast of the amount of units that we're going to sell per product. So we'll go ahead and do product 1, product 2, and product 3. And then we're going to go ahead and put in the months here. So we'll say this will be for month 1, month 2, and all the way to month 12. All right, and then, so this is kind of all assumed. We need to just kind of predict for this first month how many socks we're going to sell, and then we'll use these growth rates to adjust this for the following months. All right, so for month 1, we basically just need to determine we need to predict the units sold based off of month 1. So for product 1, let's say we sell 1,000 pairs of socks. For product 2, let's say we sell 500, and we sell 0 for product 3 because we don't have it yet. But we're going to release product 3 in month 3. And let's say that third month we predict to sell 700 pairs of socks for product 3. All right, so now what we can do, now that we have our estimates, we can take these growth rates and just take the previous month and times that by the growth rate. And we'll go ahead and lock this as well. And we'll do that real quick for both of these. For some reason. All right, and for this last one, all right, so then we can go ahead and drag these across. And here we'll get some nasty decimals, but we'll just kind of get rid of those. So here we have our predicted, and we're also going to make a totals column over here. So we'll just do the sum function for all of these, and these are the amount of socks we will be selling. 42,677 pairs through our 3 different sock products throughout the year. All right, a lot of socks. All right, so now we can move on to the actual pro forma, the actual income statement. We'll go ahead and label that, expand this. So we're going to copy these again. We'll just copy them down here. All right, so if you're familiar with income statements, this will be pretty simple for you. And if you're not, just pay close attention, and hopefully you'll kind of learn how to actually create an income statement and learn how to read certain things. All right, so we have, starting out, we have our revenues. For each product, we have our 3 products. Go ahead and paste that there. All right, so we have our revenues for each product, and basically what we're going to want to do for this, we're going to want to go ahead and take the predicted sales of 1,000, and we're just going to want to times that by the revenue per unit that we assumed above here. And we're going to want to go ahead and lock that as well. We'll get rid of the decimals here. And we're just going to want to do that for each of these products. So 500, and we're going to want to times that by this revenue, right? Go ahead and lock that again. And for this last product, we're going to want to go ahead and lock that again as well. All right. And so we'll go ahead and drag this across. We're going to go ahead and get rid of these decimals and make that a little bit nicer to read. All right, so as you can see, obviously we didn't sell any of product 3, so no revenues for that product. And then we're going to go ahead and write a totals column for each month. And we'll just do the sum function of these and drag that across. And then we're going to want to do a sum function here. And there we go. All right. So here we have the revenues for our 3 products and the total revenues for the year of 468,000, close to $500,000. All right, so after revenues, what you're going to want to do is you're going to want to do cost of goods sold, or COGS. For the 3 products again, and we're going to go ahead and paste that. And then for month 1, basically we do something similar to what we did up here. We take the cost per unit, and we're going to want to, again, lock this cell, and we're just going to want to times that by, again, the predicted units sold for that month. All right, and we're going to want to do that for each product, and then sum these again. All right, so just doing that real quick again to kind of show you. You go ahead and lock this and times that by the product number 2, and you do the same for this product as well, and lock that cell. All right, so by locking that cell, it allows us to drag this across and kind of get the totals here. So we're going to go ahead and get rid of all these decimals again, and just do the sum function across here again. All right, perfect. So we have our cost of goods sold, we have our revenues, and now the next step of the income statement is the gross profit and the gross margin percentage. All right, well, hopefully you guys are still here. It's getting a little bit boring, I know, but super important stuff, especially when starting a new business, or just being able to read income statements is important. All right, make sure you hit that subscribe button. It really helps me out. Smash that like button, add a comment if you like this video, or if you have any questions, please let me know. All right, so moving on here, gross profit is just the revenues minus the cost of goods sold for the total of the 3 products, and we have a gross profit of almost $12,000, right? And so then our gross profit margin is you take the gross profit and you divide it by the revenues, and you get a percentage here. And we'll go ahead and drag these across and sum this up. And this is our predicted gross profit for the year. Not too bad. All right, just selling socks. All right, so now we get on to the more assumptive part of an income statement if you're doing a pro forma. And this is the expenses, right? So we need to know the operating expenses here. And these can come in tons of different ways. We're just going to cover a couple. That's not going to include all of operating expenses in a normal business. We're just going to list a few here to kind of get you guys a good idea of that. So we have marketing. We have the marketing expense. We have research and development. You know, we got to find out. We got labor. Let's say we also rent a building, so we have a rent expense here. And generally here you would also include a depreciation expense, and this gets a little bit more complicated. All right, so depreciation gets a little bit tricky because you need to have information on your balance sheet, which we're not going to be covering in this video. So we're just going to leave depreciation blank for now. But hopefully in a future video, I'll do a pro forma balance sheet statement using the same income statement, and we'll be able to calculate depreciation. All right, so we'll just leave that here, but put that as 0. So let's say for our marketing, we're going to spend, let's say, $300 a month on marketing. and all of this is kind of assumptive, right? So you just kind of predict what you think this will be to your best estimate. We'll go ahead and put this in currency here. Or sorry, we have the rest in accounting. So we'll go ahead and put this in accounting format. And so research and development, let's say that's not a huge thing. So we're just going to spend like $30 a month, testing new socks and doing that. All right, so with labor here, we're just going to create a new worksheet real quick to kind of go through some simple math for to predict our labor. So a way we could do this, let's just say we pay our employees $15 an hour. And we have 2 employees running the store. They work Monday, let's just say Monday through Saturday. We'll be closed on Sundays. So they work 48 hours a week. We have more than 2 employees, but we only have 2 employees at a time. So 48 hours. So we'll do 48 hours times 2, 8 hours a day, just to keep this simple. So we'll do 15 times 96. So we're paying about 14.40 in salaries and wages, or in labor expense per week. So we'll take that and times that by 4 to get about 5,760 in labor per month. So we'll go ahead and put that down here. Rent, let's say that's pretty fixed. We're paying, let's just say $1,000 in rent. Not 100, 1,000, not 10,000. We're paying $1,000 in rent per month. All right, so we're also going to say each month our marketing increases by 5%. All right, so we're going to take 300 times this 5%, and we're going to want to go ahead and lock this as well. Oh, whoops. We're going to do 1 plus here. All right. Our research and development, we'll say that stays the same. Labor stays the same. Rent stays the same. So we're going to go ahead and say that equals this. Month 2, month 3, and so on, right? And then we can just go ahead and drag this across. And then for our total expenses, we'll just do another sum function of these and get that. And we'll go ahead and make a total column here for total operating expenses here. And that's just going to be the sum function of all of our expenses dragged across, right? All right. So in total, we're spending $86,000 in order to get all these socks sold for our operating expenses. All right. So now we're going to want to know our operating profit, which is also known as EBIT, however you want to pronounce that, if I can spell. And that is just earnings before interest and taxes. That's what that stands for. All right, so also very simple. You just take our previous gross profit and you subtract our total operating expenses to get our operating profit. So this is how much operations after our operating expenses, how much money we're bringing in after we pay for all of our expenses, right? All right, so then after finding our operating profit, we're going to want to know our operating margin percentage as well. And that's just taking this, our operating profit, divided by the total revenue, which is here for month 1. And we can drag this across, get a percentage here. All right, so we're almost done. I know if you're sticking with me, I hope you're still here. Super important, but make sure you subscribe, hit that like button. Please do that for me. All right, so then we have our interest expense. We're almost done. The income tax expense, and then we will be able to find our net income, which is the goal here. All right, so for our interest expense, we're going to say that we're not going to mess with that right now because we need to kind of dive into the balance sheet. So when I talk about the pro forma balance sheet in an upcoming video, we'll be able to kind of understand this a little bit more. But as the interest expense, for now, we're just going to say that is 0%. All right. Our income tax expense, let's just say, to keep it simple, we'll just say 30%. All right. All right. So for our interest expense, we're just going to go ahead, hit our operating profit, and multiply that by the interest expense. Obviously, we know that's going to be 0 because we said 0%. All right. But we can do the sum formula across here for the year. And so this is just the total column for the year. All right, so for our income tax expense, we just want to take our operating profit and we want to times that by the 30%. Make sure, again, to lock this, super important. All right, and then we're going to drag this across, go ahead, get rid of those decimals, and get another sum here. All right, so now we calculate what we want, right? Our net income. So basically, that's just taking our operating profit, you subtract interest expense, and you subtract the income tax expense. And that gets you our net income. And we'll go ahead and do that, do a sum function, and voila. After all of our expenses, we will make around $200,000 as a business in net income selling socks. Voila. All right. So this is hopefully a detailed enough overview of how to make a pro forma income statement. Hopefully this is helpful, kind of gets you to understand what revenues, cost of goods sold, how to calculate profit, where expenses come in, and everything needed to get to your net income. Make sure you subscribe, hit that like button. Hopefully you were able to stay tuned for this whole video, and stay tuned for the upcoming pro forma balance sheet video that will be releasing soon.